With all the talk of tax increases and changes to tax laws, you might be wondering if you should do your taxes differently this year. The answer is yes. Taxpayers should be proactive, not passive. And here's why. Many of the tax cuts and provisions from the 2017 tax law are set to expire after 2025. This includes the expanded child tax credit of 2025, which is set to drop back to $1,000 per child. At the same time, tax rates will rise back to pre-2018 levels. And the standard deduction, which is currently $27,000 for married couples filing jointly, will drop by roughly 50%. So what should you do? Well, experienced filers know to take advantage of today's historically high standard deduction and generous tax exemptions while they can. That means making pre-2026 retirement contributions, taking full advantage of deduction planning strategies, accelerating estate or gift transfers, and maximizing charitable giving now before the rules change. Of course, Congress could always change these rules. Lawmakers are actually considering a bill to extend many of these provisions. But as we all know, Congress is unpredictable, so it's best to plan for all scenarios, and that means planning under current law. One of the smartest moves in uncertain times is to fully leverage tax-advantaged retirement accounts. Not only do these boost your financial security, they often come with immediate tax benefits or future tax savings. Max out tax-deferred accounts. Contribute as much as possible to employer plans. 401(k), 403(b), TSP, and traditional IRA contributions lower your taxable income and AGI. For 2025, 401 limits are $23,500, and IRA limits are $7,000. Leverage Roth opportunities. Roth IRA's 401s offer tax-free growth and no RMDs. Contributing now locks in today's rates before the top rate jumps back to 39.6% in 2026. Backdoor Roth for high earner. If your MAGI exceeds $236,000 or $150,000, contribute non-deductibbly to a traditional IRA, then convert to Roth. No income limit on conversions. Catch-up contributions. Age 50 can add $1,000 to IRAs and $7,500 to 401s. Ages 60–63 get an $11,250 catch-up in employer plans starting 2025. Consider Roth conversions before 2026. Convert portions of traditional IRAs, 401s to Roth, in 2025 to lock in lower tax brackets. Pace conversions to avoid pushing into higher brackets. Currently, the standard deduction is historically high, $15,000 and $30,000 for 2025. This makes itemizing rare, but it could flip in 2026 when the deduction drops roughly in half. To decide, itemize if your deduction's greater than standard. Common itemized categories. State and local taxes. Caps at $10,000 through 2025. Cap disappears in 2026. Mortgage interest. Deductible on up to $750,000 of new mortgages. PRE 2026 rules may revert. Charitable contributions. Deductible up to 60% of AGI cash gifts. Cap drops back to 50% in 2026. Medical expenses. Deductible over 7.5% of AGI. Concentrate deductions into 1 year to surpass the standard deduction, then claim the standard in alternate years. Consider a donor-advised fund for charitable bunching. Estate tax may not be top of mind, but 2025 offers a use-it-or-lose-it opportunity. The federal estate SIG-DIFT exemption is $13.99 million per person in 2025, set to revert to $6.8 million per person in 2026. To lock in the higher exemption, make large lifetime gifts in 2025. Use your exemption now. No clawback if the exemption shrinks later. Gift vehicles, outright gifts, irrevocable trusts, or discounted business interests. Work with an estate attorney to structure gifts safely. State estate taxes. Some states impose their own limits. Plan accordingly. Annual exclusion gifts. You can gift up to $17,000 per recipient annually without using your lifetime exemption. Beware of pre-2018 gifts. Your remaining exemption is cumulative. Topping up before 2026 can remove future appreciation from your estate. Charitable giving is both philanthropic and a tax tool to maximize impact. Time your gifts. Standard deduction cuts in half in 2026. Consider delaying large gifts until 2026. If you won't itemize in 2025, Use a DAF to bunch multiple years, giving into 1 year. Leverage higher caps. Cash gifts deductible up to 60% of AGI in 2025. Front-load large contributions now qualified charitable distributions. Ages 70 can donate up to $100,000, $105,000 from an IRA directly to charity, excluding it from income and satisfying RMDs without itemizing. Donate appreciated assets. Gift long-term stock or mutual funds to avoid capital gains and deduct full market value. Watch for new rules. Proposed above-the-line deductions for known itemizers could change strategy. The tax landscape in 2025 is marked by opportunity and uncertainty. We currently enjoy low rates and generous credits, high standard deduction, historic estate, gift exemptions, enhanced charitable limits. But many of these sunset after 2025. To maximize savings, max out, pre-fund retirement accounts. Strategically choose standard versus itemized deductions. Use bunching. Use higher stake gift exemptions now before they drop. Time charitable giving to when it's most valuable. Stay flexible as legislation evolves, and consult a tax professional for large or complex moves. By proactively planning under current law and anticipating future shifts, you can minimize taxes and keep more of your wealth working for you.